Hi, everybody. Welcome back to another episode here at Beyond the Breakpoint. I'm your host, Matt Garnett. My partner, Zach, is enjoying life somewhere around the world. Stephen, he's got a wealth of knowledge and experience in this field. I'm not going to butcher it by trying to introduce him. I'm going to let Stephen tell you a little bit more about Stephen and what he does. Stephen, can you tell our listeners a little bit about you and your background, please?
Sure. Thanks, Matt. Currently, I'm running a single family office with my son. We're managing only our own family capital. I have a family background in real estate, primarily ownership and management of high-rise residential apartments. My wife's family is a manufacturing and distribution family in the US and Canada. So having spent 30 years practicing law outside of the family business contexts, and then a few years working with a high net worth family after I left the practice, I'm now focusing on the capital that we have at our disposal, and preparing for future liquidity events at some point in the future.
Yeah. Exciting times, interesting times for sure, managing family office. Things are changing rapidly. I'm sure you would agree. So I know what a family office is. I work for one, so I get it. They range in terms of size and scale and assets under management. Steve, can you just dumb it down for a minute and just give everybody an understanding of what it actually means to own and operate a family office? What does that look like?
It's a great question, because I think that it can mean different things to different people. I view it as an entity that focuses primarily on the management of capital for the family unit, and that could be a small unit, that consists of one generation, but in most cases it's multi-generational. So you are dealing with children, maybe grandchildren, perhaps siblings and their children, but it is focused on wealth generation for family, and often provides other functions in conjunction with the family's activities outside of core operating businesses. So it can deal with philanthropy, it can deal with succession, it can deal with things as mundane as banking, bill pay, those kinds of things.
So, Steve, you touched on three things right there that are all like on my list of questions for Stephen, thank you for that. They're wonderful segues. This is great. So the family office that I've worked for has been a real estate owner and operator of multifamily real estate, also in the development space. So the buying and titling of land, the constructing of purpose-built rental real estate, which, as you and I both know, Stephen, painfully right now is the only thing getting financed, the only thing moving here in Toronto, Ontario, Canada at the present moment, and probably for the near foreseeable future. That being said, one of the things that you mentioned, which is really interesting, is the family office can span generations. It can be parents, children, maybe even in some cases grandchildren. How do you manage the competing or the differing desires based on the differing generations?
Well, fortunately, for speaking personally, I don't have to yet worry about conflicts that extend beyond a small family unit, my wife and I and our three children, and ultimately their partners. There is no third generation in the picture yet, but I envisage this as multi-generational. But at the same time, it will be fairly easy to unravel it if that's what the next generation desires. And so I view transparency and trust as the key elements to best preserving the family office as a multi-generational entity for the future. And so I'm focused on reporting. I'm focused on full disclosure to all stakeholders and treating family members as if they are shareholders of an operating business, or even better, as directors, so that there is no information that is not capable of being shared with them.
Which is so that's great, because that's probably the only way that it actually works. Having family and then having business sometimes collide, but if you can treat the family the way that a shareholder would want to be treated, or a board of director, or something else like that, it might help for making those decisions a little bit easier.
At the same time, I'd say it is up to my wife and to me to set the groundwork in terms of what are our goals, what is our vision for the future, so that there is no confusion around what we're trying to achieve, what we hope will come from this enterprise.
Yeah.
And either there will be alignment into the future or there won't, but someone has to start it and someone has to live it, for lack of a better term, if we're going to fulfill that multi-generational ambition.
Yeah. No, I completely understand what you're speaking about, and it resonates, because you touched on one word there that's a really big buzzword right now, which is succession planning. And we are seeing that. I mean, I have two other clients who are family offices where we are seeing the passing of the baton, the changing of the guard, and we're seeing, okay, Bubby and Zadie did this, or they did this all their lives, and they were heavily weighted on real estate. We want to be in more professional services, or we want to look at digital assets or crypto, or we want to diversify. With that succession planning, how do you assuage, the younger generation that might want to get involved with things that weren't part of the core?
Well, the core really is unrelated to what we're doing. If you mean by the core, you mean the historical wealth creation vehicles for the family. And as I mentioned, those represent future liquidity events. Now they're currently operating separate and apart from what the two of us are doing day to day in here, and their sources of capital and cash flow, and help underwrite this enterprise. But our function is a little more mundane than perhaps the term family office might suggest. We're in the wealth preservation business, with reasonable growth. So the first rule is don't lose money. And with a modest goal of doubling our investable capital every 10 years or so. And you do that by generating roughly an 8% compounded annual return on average, year after year. And after 10 years, the math suggests you'll have doubled your capital. That we're going to do by creating a diversified portfolio across a number of asset classes. And there's room within those allocations. Let's say that I'm talking about an allocation to alternative asset classes. There's all kinds of opportunities within that space for someone who's involved with us here to say, hey, I'd really like to look at this strategy or be actively involved in this strategy. And then it becomes an investment choice just like any other. And it will be measured against the same kind of critical analysis that we would apply to any other investment.
Okay, so loving that, which is giving the breadth to have the younger generation look at alternative investments and, not limit the exposure to some extent, right? So that's a great segue because you mentioned it was more of a mundane thing. And I said, well, what does a typical day look like for Stephen Bloom? Walk me how mundane is it, Stephen? Like you tell me.
Well, yeah, every day can look a little bit different, but in my role where I view myself as being in a caretaking role and in a sort of more of a role providing guidance than operational. My day can be actively dealing with a sponsor, a potential manager, can be networking, lunches, dinners, conferences. It can be sitting down with my son and going through the diligence on a potential investment, or it can be very quiet. I mean, managing a portfolio is not, constructing and managing a portfolio is not necessarily a day that has the intensity of being a partner in a corporate law firm.
No, I understand. Yeah.
So
So at this stage of your career, are you enjoying the move from having been in that corporate law firm to basically being the custodian of the family assets?
Yeah, I've enjoyed the evolution, from being a pure advisor and having a front row seat to a lot of other people's success and helping them manage risk and getting to the finish line on transactions that was going to grow, that were going to grow their wealth, to an operational role within a family business, not my family, but another high net worth family, and getting my feet wet around the operation, being in the operational realm myself, taking a little bit of risk with my own capital in the development deals that I was overseeing, to now being the allocator of capital. It's been a really nice evolution, and to be here at 63 years old is a nice place to be.
You're doing well. Look at all the hair you still got, Stephen. I'm jealous.
Good genes. But it's a lot whiter than it used to be.
I got that. I got the, the beard goes white. I just cut it really close so you don't see all the grays. Trust me, Steve, it's there. One thing you touched on, which is really interesting, in your background when you worked for the other high net worth individual or family, and then had the corporate backing with the law practice, I would assume that you were party to seeing certain shifts and or trends within the industry, and you're able to benefit from that and bring some of that over to your own family office. What major trends and shifts are you seeing right now, Steve, in your practice that you could see happening over the next 5 years, let's say?
I mean, that's a tough question to answer, Matt. I'm as a lawyer, there were certainly a lot of changes throughout the 30 years that I practiced, primarily the impact of technology on the practice, from voicemail being considered a new and innovative addition to the day-to-day practice of law, to the BlackBerry, to Zoom meetings, what have you, being able to practice virtually. That was the primary change that I can look back on. And I haven't been at the law firm since 2016. So since then, work from home has become a thing when it was not, when I left.
Well, COVID really was instrumental in really bolstering that, I think, Stephen. And now that just seems to be kind of the word.
Yeah.
Yours.
I was in my next role when COVID hit, and we were in the office one day and in 10 minutes decided to send everyone home, and over the weekend ensure that everyone was equipped with the technology they needed to be able to work remotely for the foreseeable future.
Yeah. Yeah. No, thank you for that. And I'm going to step back a bit because I think a little bit of that is on me. I may not have articulated that the way I wanted to. What I was more intending was within the family office and capital, specifically related to capital, the market, Stephen, what are you seeing as in terms of a shift now that maybe wasn't there 2018, 2019, early 2020 before COVID?
Yeah, I do understand your question. I I think that the family office universe, um, and there's a long history of family office enterprises in North America and in Canada, although a lot of Canadian family office enterprises have flown under the radar for a long time, and you wouldn't know who I'm talking about by throwing out some names of some significant family offices. They figured out fairly early on that there was uh, a real edge in manager selection, asset selection. So they had been moving into alternatives or privates well before products were created for more of the retail investor that you see today, and doing what sophisticated pension investors or endowment investors were doing for their institutions. Now, and I am only 2 years into this, so when I started this office, that change had really already occurred. But I think that continues to be a changing landscape, and that is the prominence now of the alternative universe and how much is out there versus the typical 60-40, as they call it, public equities and fixed income portfolios.
Yeah, no, I'm there with you. I think the alternative investment landscape is rapidly growing amongst family offices and amongst retail investors are always a little bit nervous and skittish, but I think some of the family offices are looking at certain assets and going, okay, well, maybe they're not a flash in the pan, maybe we need to increase our exposure. And that typical weighting of 60-40, however you define that 60, was a certain percentage of that 60 in real estate and a certain percentage in oil and gas. And I think these alternative investments soon might even find their way into that 60%. I don't know. Possibly, possibly not. But looking at current state, looking at Stephen Bloom and the family office current state 2 years into it, what do you think right now, Stephen, is working well for you guys over there at Batl Capital?
Well, it's a little bit early to assess our performance around the capital we've deployed into various investments. We've made some fund investments that are going to take 7 to 10 years to play out their natural life. We've made some co-invests alongside sponsors. By co-invests, I mean direct investments in operating businesses with private equity sponsors. Those will our scorecard will arrive earlier on those
3 to 5, something like that,
than on the fund investments. But I view our success a little bit differently at this stage than trying to anticipate how we're going to do ultimately on liquidity events in several years.
Right.
I view our success as, how good do we feel about the steps we've taken and are taking to construct the portfolio that's risk managed and diversified across asset classes and geography that we set out to when we created a so-called investment policy statement at the outset.
Right.
And how good do we feel about the network that we've created, the collaboration we're managing with other family offices and with players in this space. And I'm pleased with all of the progress we've made there.
And does that include your consultants on there, Stephen, to help you with the diligence on these things, and your external consultants as well?
Yeah, we rely in terms of consultants. Our primary relationship is with a group that helped us construct our investment policy statement and does all of our reporting and benchmarking. And so they are gathering our data throughout the year and reporting to us every quarter on how our portfolios, both public and private, are doing against accepted benchmarks. And that's sort of a scorecard I've never thought I needed before.
Right.
But now that this is all we're doing, it's critical that we have that.
Oh, 100%. You got to know how you're performing, Stephen, right, against it. So, I mean, that that benchmark scorecard, however you set up your own bylaws for your own private office, it should serve basically as a floor, I would imagine, right, as a bare minimum to get you to that 2x over 10 years or whatever your charter calls for, right? I would imagine. So I guess we've kind of talked about the metrics already because we just went over that right now. So that's why it was such a great lead and a great segue. I guess what I would look at asking you are looking at future goals. What you've made your capital investments. What do you think the next 6 to 12 months looks like for Stephen and Batl Capital? Are there more investments you're doing diligence on, looking at making, or you're putting a bit of a pause on it, looking at where the market is? I'm trying to get where Stephen's going.
Yeah. Well, I still consider us in early innings in terms of deploying capital into the alternative spaces that we've decided we will allocate to. So the next 6 months will look like it has for the last 12 months or so, where we will be assessing both fund and non-fund investments in these various spaces. I could go into them if you want, but I don't think you'll be surprised by the kinds of categories we consider open for our capital. It's when we are so-called fully allocated, then we'll have to ensure that we've done a good job in terms of vintage diversification, and ultimately we're able to recycle capital as liquidity events occur within each of these categories.
Well, I mean, once you're fully expunged on your capital, or you're fully invested in capital, I don't know how the liquidity events look, but would you be looking to leverage on those investments if you found a really good investment that you wanted to, or are you guys risk averse to leverage and you want to put capital only?
I don't see us adding leverage to our investments.
Fair.
Overall, as a family, we're very low in terms of leverage. Even in the operating businesses, there's virtually no or little leverage, and so that's served us well. And with the modest goal, we may not have grown as quickly as others who have used leverage as a springboard to rapid growth, but we just didn't do it that way. And that's how we're in our third generation now, and still moving forward. So that approach is very likely to remain our approach. And with the modest goal of doubling our investable capital every 10 years or so, we don't need leverage to do that.
No, you've got your benchmarks put up, and you've got your investments that are going to take you to that 2x level, and you've got the patient capital. So if you can wait the 7 to 10 years to realize those gains, then you don't need to. It's the people that want to see the 2x in 3 years who need to
And don't get me wrong, Matt. There are certain kinds of investments that we would not underwrite at a pro forma 2x. We would just say that's not enough return for the risk we're taking.
Right.
But when you average all of the investments we make across different asset classes, which includes fixed income, your return is more geared toward downside protection than it is toward upside protection. So
Capital appreciation.
you need some three baggers or better in order to achieve even that, that doubling every 10 years or so.
So look, it's no secret that at one time, Stephen, okay, back in 2013, 2014, 2015, 2016, the golden years, let's call it, the way to get those three baggers, those four baggers, those five baggers was with exposure to real estate development in the condo space, the high-rise space, whatever. I've been in that business for 25 years, Stephen. You are no stranger to that. Neither is your family. You fully understand that. We know the same people. Understanding that landscape has changed a little bit right now. And if you look at PBR, Stephen, you don't see the same IRRs on a PBR investment. As you know, it's more of a drip model, where you got to hold it for 5 to 7 years and then look at a refi, but it still represents cash flow, and it's still great for the portfolio. I would imagine your family office still has, exposure to multifamily PBR. I would be shocked if you didn't.
My family does, as an owner and operator of purpose-built rental.
Right.
But as a family office, aside from one legacy investment that showed up in my personal portfolio one day in a private REIT, we have none. Oh. And we're diversifying away from PBR.
Interesting. Okay.
Not because real estate isn't worthy of our capital. It's just we are mindful of how significantly invested we are already through the operating business on my family, on my side of the family. But you're right. If we want to talk about purpose-built rental for a moment in development,
yes,
I looked at a lot of pro formas in my previous role, purpose-built rental, condo, and condo's a whole other discussion topic. But purpose-built rental always, for anyone but institutional capital, where your allocators has so-called low cost of capital,
right,
and doesn't mind a 3 or 4% return over a very long period of time. For normal people, apartment requires a massive amount of equity that becomes permanent. So it is stuck in the investment alongside your senior debt, which you'll get your CMHC financing and pay a reasonable mortgage once you've achieved stabilization, which means you're roughly 90% leased. Yeah. Until then, you're paying floating rate construction financing. Right. Can be very expensive, and the cost of land, the cost of the bureaucracy, or getting through the bureaucracy in this part of the world, it makes the pro forma almost impossible to make sense of.
Stephen, I'm so glad you touched on that. 25 years of my life, I have been embroiled in real estate entitlements, development. I have these conversations with Councillor Brad Bradford because he's one of the only ones, frankly, who kind of gets it.
Great guy.
I love him, and I'm all for Brad. He's got my vote. And his wife's a planner. She understands, right? He gets it. And I think you would agree with me, Stephen, that there is something very broken within our land use planning act right now, when the average, as an OECD nation, an average, it takes us 964 days to receive any kind of approval, there's something wrong. There's something very wrong to get a zoning bylaw amendment or an official plan amendment. Even an SPA, takes over 18 months to get.
I completely agree.
Wrong.
And it introduces an element of risk into the decision to invest in a development project that's really hard to assess in advance. You'll hire the best planning firm that you can and the best planning lawyers on your team to navigate the approvals, but the outcome is still uncertain. And any change in your assumptions changes your financial forecast. And yet, with condo being so out of favor, developers who have done not much more than condo for a number of years are trying to pivot to projects like purpose-built rental and make those make sense.
Even they're calling me every day. That's what we do, right? So, I was on the condo side for 20 plus years before I came to the purpose-built side. And what I can tell you respectfully is I had to unlearn 20-ish years of the condo and the freehold and the vendor mentality, because it is a different business model. Like it actually is. Being an owner operator of a PBR multifamily building or assets like your family owns, Stephen, it's distinguishably different than being a builder and vendor of real estate, because you really have like that line item on your OPEX that says R&M, right, can shoot up like exponentially based on what you put into the development or the construction of those units. When you're a condo builder, you hire your architect and your designer, and you put together a lovely, beautiful brochure that's schwanky. It looks beautiful in a sales office. Everybody comes in, the hype is there, they buy it, and you build it, and it's their baby to look after when you do the 1 year turnover. Fast forward to you being an owner operator. Tenant moves out. We've got Bill 60 that just got passed even. Hooray. Maybe things will be different, but they don't give a shit. They move out, they dent your walls, they do this, they do that. If you're putting in the wrong materials or making the wrong floor plan, right, with too many 90-degree jogs or whatever, you're just driving up the R&M that you've got to go and get somebody to come and fix before you lease to the next tenant, which drives up your OPEX and hurts your NOI. And a lot of these guys don't seem to understand that. And parking is the other thing that absolutely kills rental pro forma, because you can't pre-sell any of that parking. So we're actually seeing applications now, Stephen, where we're consulting with people and looking at down zoning applications, if you can believe it. If you remember, Steve, back in the day, it was, oh, I've got a half-acre site. I think, I can get 9 times FSI. I'm going to shoot for 15. I end up with 12. I beat it by 3 times FSI. That's money in the bank, and we can go sell it, and anybody will buy it based on our FSI. Those days are gone. Those days are gone, right? It's what does the market actually need? 300 square foot boxes in the sky to investors isn't going to work anymore. They need to be livable. And the only thing being financed right now is a rental product that you can take to CMHC or ACLP or whoever later and look at putting your finance. But your cap stack has to be structured right. You've got to have a great design team. You've got to have the right development team and everything into it. So it's not for the faint of heart. And
I've been saying the same thing for a while now. I saw the peak in 2021 and realized that developers were making reckless assumptions around what people actually will want into the future and what they will pay for it. There was not a pro forma I saw that didn't show the exact same 15% margin at the end of the day magically by moving the revenue number to whatever number got you to that point. So that they all backed into the same margin, because there was assumption that if it's 1,200 today, if it needs to be 1,300 a foot tomorrow, that's what the market will
Yeah.
provide you. And the cost side just went crazy.
Wild.
And that hasn't resolved itself. But the bigger problem, as you identified, I think, is 400 square foot, one bedrooms, or 1+ dens at 500 square feet that
Yeah.
investors are buying because they're accumulating portfolios of rental units that they believe are appreciating in value over time. That buyer is gone, and you're left with nothing but end users who don't want that product.
And the downzoning begins. Now we're seeing the downzone, right? Oh, I could build a 45, 50-story tower, but I got to go 5, 6 levels underground. Maybe I'm better completely scrapping this, depending on what I paid for my land contribution, looking at changing this building to a 15-story or a 20-story and having 1 level underground and see how that pencils out, models out. And that's what we're seeing right now.
But what we're seeing on the ground is there is nothing coming to market other than luxury end user product in some pockets like Forest Hill, and nothing else is coming to market.
Right. Well, I think that's because a good friend of mine, and you probably know him, has Thelma in Forest Hill. He's released, little Daryl. I think their feeling on the matter is, if you're at one end of the spectrum and you're on the ultra luxury or the uber luxury, to have a truly remarkable project that's not repeatable in a great location with secure design, interest rates don't affect those people. They'll buy if it's truly one of a kind, irrespective of market. That's the mindset there. But not every site lends itself to that. So it's really the bulk of the development that has stopped. And the only way to make it go forward is to convert it to rental if it qualifies, and not all of them do. So I think
you can't convert it to student housing if you're not near a school. You can't convert it to seniors housing because that's an operating business with 200 employees under one roof,
right,
with demographics that may or may not create any demand whatsoever for seniors housing. So there's
Steve, because a lot of it's absorbed, right? So, with the Amicas and the Chartwells of the world and everything else, right?
There's not a lot of places to turn, and self-storage is kind of playing itself out too. I think, there's only so many uses for a site.
Right.
And so I think we're going to see a fair number of demolished buildings and empty lots spread across the city for some time.
And that's a scary part that resembles a portion of Hong Kong that they went through that. If you remember, they were paying to actually tear down half built up buildings at one point.
It's cheaper to demolish it than to maintain it.
Correct.
But look, we've seen this before. I used to look out my office window in the late 80s and see an elevator stump sticking out of the ground at Bay and Adelaide for 20 years until the Bay Adelaide Center finally got built. So this is just a reminder that real estate is cyclical.
Yep. So this is what we talked about earlier, Stephen. This is where some of that white that you enjoy, some of the gray that I've got, might come in handy to our millennial generation and our Gen Zers now coming into our workforce, Stephen, in family offices and professional capacities, who, no fault of their own, weren't alive and didn't see 1988, 89, 90 with the Black Monday that you and I remember in the real estate market. So what would Stephen Bloom say to them to try to keep their spirits high and let them know that life will go on and things will be okay?
Yeah, I do recognize that there was a long period, particularly in the real estate context, of nothing but prosperity and increasing values. Every project was pretty much going to be successful if it was executed properly. All good things come to an end, not permanently, but real estate is cyclical. And if you have conviction and you like if you like the industry, find a way to stay in it, if you can, because it will come back. You know, but those late 80s and early 90s that we both reference now saw a lot of big players and small players exit because they simply couldn't hang on. You know, and I imagine jobs are scarce in real estate related businesses. I don't know. I haven't tested the market, and I'm fortunately not out there looking for a job. But I can only guess that jobs are scarce. So it's perhaps easier for me to say it, stick with it, than someone who has bills to pay.
On the construction side, there are for sure, some of our boys sitting at home, on the couch for sure. And on the professional services side, they are seeing contraction there for sure. And that's, Mattamy laid off how many, 9,000 or whatever it was, right? So that's coming.
Yeah. And it was, I don't know, as recently as 3 years ago, we were fighting for planning managers and analysts. Our people were being poached every day, and they could have pretty much any job that they wanted to. That's just an indication of how hot and cold the market can be.
Stephen, you mentioned something earlier. I just wanted to, to end off on this. We talked about, how you get to that kind of weighted average of a 2-time multiple. And, like you said, you got to have some 3-baggers, some 4-baggers. At one time, real estate development was the thing to get you there and get those 3-4 times X. We know that. If I could give you a magic wand, if I said, Stephen, here's the magic wand right here. I can give you one thing, the only one. What would be the one thing that you would take this magic wand and wave over your business to get you, overperforming against those benchmarks? What would it be that you would want to see improved?
I don't know how to answer that easily in an investment context, because when you're investing or creating a diversified portfolio, you need performance on average across the entire portfolio. But where the kind of biggest wins come from that I'm seeing early on, have been in private equity, and investing either directly or indirectly through funds in operating businesses that ultimately create exits for the sponsors at 3, 4, 5 times or more. That's where we want to be.
And what sectors are those in? Are they alternative investments? Is it oil and gas? What sector seems to be attracting Stephen right now?
We're agnostic in terms of the types of businesses we'll invest in. If we can understand them, we'll look at them. But we won't look at crypto. We won't look at oil and gas without knowing that we're partnering with someone very experienced and successful in terms of having invested in that space. So if we're diligencing an investment in a manufacturing or service business, sort of has its footprint in North America with a good track record of success and a plan for organic growth beyond simply growing by acquisition, and where a sponsor isn't making assumptions around multiple expansion. In other words, you come in at, say, 3.5 times EBITDA, and the sponsor's assuming, well, you're going to go out at 5 times because that's where the market is likely to take you. If we see growth within the business itself and a pathway, we'll deploy into that investment.
So basically, what I'm understanding is there's got to be a reasonable price earnings put on the business, and there has to be promise of organic growth within the business without acquiring growth. Is that
correct? Correct. And the starting point has to be an operating business that is spinning out positive cash flow, as opposed to a venture style investment where we're investing in an idea or in a business that hasn't made money to that point. We'll have a small allocation to venture capital, but we won't invest directly in venture capital. That will be through a fund of funds where we're not trying to identify who at an early stage, is likely to be successful.
So last part, touching on the magic wand, we talked about that, but what I probably should have articulated is it doesn't have to be performance in the fund, Stephen. It could be a magic wand that you use operationally within house, something you could do to make Stephen's life easier, make your wife's life easier, make your son, make things easier in house. What would that wand look like? What would it be for your family office?
Yeah, I don't know. I think that because day to day I'm here with only one person, with my son. My hope is that this will be his career, a career that's fulfilling for him, where he generates the confidence and trust of his siblings, and at some point I'll simply stand back and either they will also get involved or others will get involved, but it won't be my show. It will be their show. And that's how I hope it will turn out.
So that's my ending question for you, Stephen, which is that's all on succession, and that's something that's real. But I don't know if he's your eldest son or your middle or your youngest. I'm the eldest of 3, and I've got 2 of myself. If Stephen steps away, does Stephen and Stephen's wife form a board and sit on the board to still give that guidance and let them handle the day-to-day? Is that what succession looks like for Stephen?
Yeah, I'm hesitating because succession means a couple of things. It means, have you properly planned for your death, frankly, from a tax and...
I apologize. I didn't mean it that way.
No, it's no offense taken. But I know what you meant. I'm simply expanding the answer to include what I view as succession. So you've set up a legal structure and your estate for success so that assets transfer from one generation to the next as seamlessly as possible and as tax efficiently as possible. Operating succession means something else. I mean, from day one here, I haven't put any restrictions on Trevor, that's my son's name, in terms of what he wants to look at, what he wants to get excited about. We have to agree on everything that we do ultimately when there's a decision to invest or not invest.
Right.
But I'm not trying to control that process. And as long as I can, I will always be here to be part of the final decision, or at least provide guidance. And maybe that's the answer to your question. At some point, there may be a shift to, am I involved in the final decision or am I simply providing guidance?
An advisory seat on the board. I don't know. Who knows, right?
Whatever we call it, right? Because our family unit is small enough right now, I'm not responsible to stakeholders outside of a very small group. We don't need to be overly formalized.
which is a blessing actually in its own right. You know what I mean? So
I have met ninth generation family offices
my
along
good
the way.
Lord, good Lord, where there's like 60 members, you know, and you need to book a hotel room just to have an annual general meeting or whatever.
Well,
So,
that becomes a a very interesting study in discipline and in governance, because when assets have moved down 9 generations, one, it's remarkable that a family enterprise still exists after 9 generations, but the discipline that's required to maintain a closed system and not have pe- uh, people go rogue such that it starts to unravel.
yeah,
I have a lot of respect for
I do
those who are
too.
able to do that.
There's no sibling rivalry. There's no, you know, family rivalry because we've seen that in many offices for
Well,
sure.
there may be, but it doesn't seem to bleed its way into the wealth preservation and wealth management part of the family enterprise. Maybe they all hate each other, but there's someone in charge of the family wealth, and that's the way it is.
So I guess as the ending question here, you know, the entire world is moving into, you know, I think you would have to agree with me, Stephen, whether we like it or not. I mean, you know, we have varying degrees of opinions, and that's fine. But I feel like, you know, the digital age is here, and the role of AI, though uncertain, you know, I met with a family office, Stephen, they're clients of ours, they're a law firm. And, you know, AI poses certain legal issues with the law because you can't really use it to check case law because if it's wrong, and then, you know, and
Yeah.
judges are having a hard time with it. But they have admitted that AI can be useful in a more of an operational sense or a marketing sense. What has Stephen considered AI for the future growth of Batl Capital, and what do you think it could look like?
It's something I think about, um, but not something that I have practically thought about implementing at this stage. And maybe I'm behind the curve. Um, the two of us here perhaps are a little bit mm, old-fashioned um, around what we do every day, and more manual than we could be, perhaps. I have a daughter who's a software engineer. She may push us to become much more technologically advanced and reliant on
It's
artificial intelligence. And we have so much exposure to managers and sponsors who themselves are figuring out how to integrate artificial intelligence into what they do, as well as the operating companies they oversee. So over time, I think it will just happen by osmosis,
yeah.
and and some of the perhaps modeling that we do will simply plug into ChatGPT or some equivalent and say, please build this model for me, and check all of the assumptions that are made in sponsors model here. I think it will get there, but personally, we're not there yet.
Stephen, we could go on forever on this, and I promised you I would keep this to 1 hour, and I'm right at that limit right now. This has been fantastic. I've really enjoyed my time with you guys, with you here, and I hope all of you watching have learned something from Stephen Bloom and Batl Capital. We're signing off for now. Stephen, is there any parting marks you want to give to the people viewing here, which are going to see all over YouTube and LinkedIn and everything else?
Uh, well, I don't have anything specifically to add, but my profile is available on LinkedIn, and I welcome anyone watching who would like to get in touch with me to do so. I'm always excited about meeting new folks and sharing ideas and collaborating and being as useful as I can.
Stephen Bloom, Batl Capital, everyone. You'll find him on LinkedIn. Great guy, wealth of knowledge. And for everyone, thank you very much. And we'll tune in again on another episode of Beyond the Breakpoint. Thank you.